Hi guys. Today we will analyze ROST stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's overall performance in the market is below average. The short-term trend is neutral, while the long-term trend is still negative. We need to see a little more continued positive action to make this really interesting. Strong support level is around $85. Next strong support level is around $80. Resistance levels are around $95.50 and $99. Strong resistance levels are around $105 and $115. In the last month the stock has been trading between $84.50 and $95.90 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since May 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 10% per year, for last 5 years. We see that the average profit margin of the stock has been around 8% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 92% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for ROST company: bad, average, and good. First scenario. ROST will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 5%. Future profit margin would be low, 7%. Future free cash flow to net income rate would be low, 70%. In this case, the fair value of the stock today would be $57. Second scenario. ROST will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 8%. Future free cash flow to net income rate would be average, 80%. In this case, the fair value of the stock today would be $76. Third scenario. ROST will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 7%. Future profit margin would be high, 9%. Future free cash flow to net income rate would be high, 90%. In this case, the fair value of the stock today would be $99. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 4.87. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For ROST, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 19. Again, I will use 3 different scenarios for ROST company: bad, average, and good. First scenario. ROST will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 5%. Future P/E would be low, 17. In this case, the fair value of the stock today would be $54. Second scenario. ROST will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future PE would be average, 19. In this case, the fair value of the stock today would be $66. Third scenario. ROST will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 7%. Future PE would be high, 21. In this case, the fair value of the stock today would be $80. As you can see, today the stock is a little bit overvalued, $93, even if we expect the company's high performance in future. The fundamentals are decent. But based on estimates for the next 5 years, the company will show a small growth in revenue, 6% per year. And the stock has been in a downward trend since May 2021. So, the stock may go lower before it recovers. I may consider buying the stock when the stock drops below $80, and when it shows signs of reversal. Always do your due diligence. You may like the stock even at current price. I suggest at least wait for signs of reversal before considering an entry. Company strengths. ROST Stores is the largest off-price retailer in the U.S. It operates 1,483 stores in 37 U.S. states. The company has a clean balance sheet, enabling them to open new stores to drive revenue growth and expand margins as buying power increases. ROST has defensive features with a long history of consistent sales and EPS growth in all types of macroeconomic environments. ROST is focused on expanding its footprint, increasing market penetration, and leveraging overhead and advertising expenses. ROST also aims to keep operating costs as low as possible. Its labor costs are typically lower than full-price department and specialty stores, due to a self-service retail format and flexible store layout. The company benefiting over the next 12 months as the consumer weakens from fading stimulus and reduced savings. Its treasure hunt shopping experience, agile supply chain and distribution network, and merchandising strength maximize ROST flexibility while holding inventory levels in check, minimizing risk while freeing capital. ROST has a return on assets of 12.6%. This is better than the industry average of 7.7%. Its return on equity of 42% is amongst the best of the industry. Its profit margin of 9% is better than the industry average of 6%. Risks. Highly competitive specialty apparel retail market, where brand image, design, service, quality and price are the primary competitive drivers of retail sales. Higher input costs, further deterioration to the global supply chain, and other macro factors such as unemployment and consumer confidence. Rising labor costs constrain margins, with asymmetric pressure relative to online rivals considering ROST need to maintain in-store staff. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow only by 6% on average per year. The earnings per share is expected to grow by 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.